Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. 1 p.m. on the East Coast, Wednesday, September 4th. That's letter U. Tough night last night in Arlington, Texas, as Elizabeth knows, as the Yankees blew a 4-1 lead to the Texas Rangers. The world champion, by the way, Texas Rangers. This is Market Call. Guy Adami, Dan Nathan, the aforementioned Elizabeth Young Thomas. EYT, how are you?
I'm good. I got a bone to pick about sports. So I just need to get this off my chest.
A bone to pick.
The NFL starts tomorrow, right?
Yes, the league where they play for pay.
Okay, great, yes. Exciting game. The Packers play on Friday in Brazil.
Weird.
Ridiculous.
Weird.
On Peacock only.
That's
I got to get
insanity.
Peacock to watch.
Well, first of all,
the first Packer
you are
game of the
a
season.
CNBC contributor. Maybe you could get that. You know what I mean?
Think I can get some kind of code?
I actually made a mistake. Guy, do you remember it was on Fast Money? Maybe you weren't on that night. It was during the Olympics, and we were talking about streaming stuff or whatever. And I was like, listen, my parents have no idea how.
I recall that.
And turn it on. I was like, I kind of bit my lip right afterwards. I'm like, somebody's not going to like that.
Well, there's no reason to cast aspersions for the home team. That's good. That's a good saying.
No, but this is more at the NFL.
Like, yes. No. Listen.
I'm not.
Don't even. And Amanda's like, guys, please. We've talked about this. Start the frickin' show, people. Yes, Amanda, you are 100% right, and I apologize, but I will say
I need
this
to
as
get
well.
it off my chest.
Why the NFL needs that? Why they feel the need to play these games in faraway lands? You know, can't there just be something? Again, it's
trying to expand the game globally. I think it's smart.
Play here in the Etats Unis.
Well, by the way, Amazon is having that Friday Thanksgiving, the Black Friday game again. Yeah. I think that was brilliant. I really do. I mean, like, you know what they're doing all during the game? They were putting up QR codes about things that you could buy rather than rushing out to your Sears and Roebuck guy. I know you used
hooked me. I know when I was watching the games and I saw those QR codes flashed, I reached for my cellular device and held it up to the screen. Oh my goodness! I can buy this. It's
we got a lot to do here.
Shit. I mean, that's what we've become as a society, and this is not my fault, by the way, Amanda. I'm just saying. Put up the rundown because this is fantastic. Flirting with Disaster. When I was a lad in high school, Molly Hatchet, one of the great Southern rock bands of all time, came out with an album, and the name of the album was Flirting with Disaster. I'm traveling down the road and I'm flirting with disaster. That comes in the form of the yield curve going from inverted to flat to maybe even uninverted. We shall see. Chips dipped. Now what? Question mark. This is fantastic. This is Amanda Diaz at her very best. Dollar falls far from the tree. Yes, it does. And a little butters because if it's Wednesday, Dan, it's
butters.
Yeah, it is.
Hey, so Guy, before we get to some of this stuff, I want to hit a story that just kind of came out on the information. I think this
breaking news.
I think it's really important because if you think about the sell-off that we saw in tech over the last couple of days, it really did center around, since Nvidia's earnings and the guidance that they gave, and we saw this a few weeks ago, some of their big customers and the CapEx expectations, the guidance both by their customers and by Nvidia just wasn't good enough, I think, at this stage of the game. And that's why, you see, what is it, over 2 days, you saw Nvidia sell off like 17%. Is the largest or second largest market cap company in the world. Microsoft's a huge customer of theirs. We've been talking about Microsoft's, investment in OpenAI. They're talking about doing more. A lot of that investment comes in credits back to Microsoft Azure, with their cloud offering. So when you see a headline like this, Microsoft customers pause on Office AI Assistant due to budgets, a Microsoft effort to inject AI into Excel, Word, PowerPoint, all those sorts of things, getting a lukewarm response. Now, we've been highlighting some of these examples, where lots of Microsoft customers are just not seeing the return on investment from this. So I just think this is really important. I know a lot of folks, the information is a subscription service. We'll try to put the story in the show notes, but I just think that you're going to see more of this, and you're going to see that Amazon and their investment in Anthropic and Claude, which is the large language model, they're integrating a lot of stuff. I just think you're going to see a lot of disappointment over the next few quarters in this.
I don't disagree with that, which does not by definition mean that I agree, but I happen to agree with that. And it's something we've said for a while. Of the companies that have reported this quarter, the two that stick out to me in terms of their ability to monetize AI have been Facebook and Walmart. Those seemingly both those companies have done a pretty good job. Outside of that,
Did Guy freeze?
Sounds
But
like it.
Liz, let me just get one thing from you. When you think about expectations, we're going to hit Butters in a little bit and some of the work that John's doing, the earnings insight analysis over there at FactSet. You know, there's a lot of embedded excitement, I think, in big tech earnings about how, like, the integration of, you know, generative AI into their businesses. Guy just mentioned Walmart, and, you know, Walmart said AI like 7 times on their call. And you can think about ways that a huge retailer like them, you know what I mean, benefit from their own processes in, you know, internally, but then also, you know, when you think about, you know, how customers kind of engage with their website, we know that the kind of DTC stuff is growing pretty quickly. How do you think about that from an earnings standpoint? If investors have pulled forward a lot of excitement in some of these big names, you know what I
Yeah.
mean?
Yeah.
I feel like there's embedded disappointment that's coming in the next, you know, few quarters.
I think you're probably right. And I think some of that disappointment has to do with customers understanding how a company like Walmart or how companies in other sectors are even going to use this,
Yeah.
so that it's not just blind spending. Because I think it makes sense in tech, and a lot of the companies that have come out and talked about this big capex in tech, it makes sense. We understand why they would be investing there. In fact, they'd be penalized to not be investing there.
Right.
But then when you have companies come out, I don't know, for example, a food company,
Yeah.
right, who's going to just somehow integrate AI into the supply chain. I don't think customers will really understand that value add
Yeah.
until it actually happens. So they probably get penalized for that spend too.
Yeah, I mean, I guess the real promise, Guy, is that you're going to see this benefit in productivity, right? And sadly, that means like getting rid of people, you know what I mean, that are doing those jobs. But I just want to give another example of this from this document. Microsoft's vision of using artificial intelligence to take some of the drudgery out of creating spreadsheets, documents, and slide presentations is running into snags at businesses like Ascendion, a technology consulting firm. It seems like they're dropping it. So I guess my own point is that's Microsoft Office. But when you think about some of these other tools, you know, I think that, you know, these companies will benefit who license this technology, right? If they can take cost out of the things. But, you know, the issue is for a Microsoft and the hyperscalers, whether it be AWS or Google Cloud, is they run the risk of overbuilding and having overcapacity for a lot of the stuff that they're doing. And that will weigh on these stocks, guys. So that's kind of my 2 cents. I don't want to belabor it that much.
and it makes sense. And again, we're going to look at a couple different slides that suggest there is a slowdown, and we actually sort of teased that flirting with disaster in the form of the yield curve re-steepening and what that historically has meant. But if in fact the economy is slowing in the way I think Elizabeth believes, and I know I believe, then, you know, the spend that is out there that's been prevalent, I mean, almost by definition, you're going to start to see, I think, a ratcheting back of capex. And you made the point of double and triple ordering, so we'll see how that plays out. Quick look at the S&P, because we want to go to this next slide, which basically is going to tell us what happens in the beginning of the month when you see the kind of drawdowns that we've seen. Here's the S&P 500. Doesn't tell you a whole hell of a lot, Dan, other than what we talked about yesterday. You know, our failure to get back to the prior all-time highs in July, having bounced pretty significantly from those August 5th lows.
Yeah, so Liz, this is a tweet from Bespoke. The last 8 times the S&P 500 began a month with a 1% decline or plus, the index was higher 4 weeks later, all 8 times, with gains ranging from 2 to 17%. I can say that we're not going to have a double-digit percent gain looking out 4 weeks. But, you know, there's so much talk about this September effect, you know what I mean? And on average, over the last 50 years, what is it? Like, average declines have been like 1% or something like that. So when you see data like this, how important is it to you?
Well, I mean, I'm just looking at the date. Look at the chart. We've got 2 September observations in there. One of them is the deepest negative observation on the chart, and the other one is unimpressively positive at 0.3%. So I think the September effect is alive and well this year. I think some of it actually became a self-fulfilling prophecy. I think investors came into the month worried about the September effect, perhaps took some risk off the table in anticipation of other people doing the same. So maybe that's what we saw yesterday, exacerbating the drawdown. But I would say, I mean, we're in a place in the market right now where seasonality is working against us. We had some rough JOLTS data today that's working against us. We're worried about the labor market staying stable. We've got every week, it seems, some highly anticipated event or announcement. So people are on edge and the market can't decide which way to go with the data. Even that JOLTS data today, negative at first, then positive, and then back to negative. That was within 2.5 hours that happened. So I think we're at an indecisive spot. We've got obviously a big data print on Friday with the jobs data. We've got CPI next week. We've got a Fed meeting the week after that. So I think September will continue to be volatile. We'll continue to sit on the edge of our seats trying to figure out whether or not this cutting cycle is going to be good or bad.
Guy, do you think
Yes,
it's
Dan.
going to be a September to remember?
Again, you do certain things to annoy me. I'm not going to fall victim or prey to this. I will not engage in that tomfoolery at all. Nice try. But I'll say, yes, but I'll play your reindeer game. I do actually think it's going to be a September to remember. And I want to take people's eyes to that last paragraph on the right, because I think, again, of all the important things we try to talk about, this is one of the most important things. If you recall, early in 2022, there were 2 job openings for everybody looking for, or for every job that was out there, right? So now, if you look at what's going on here, it's almost 1-to-1. I mean, this is levels where we haven't seen in quite some time, Elizabeth, which is normalizing. Yep. But again, what does that speak to, and what does that portend? And those are the things we've been trying to sort of bring forth over the last few months.
Okay, so here's what's going on. We've got a job openings to unemployed workers ratio now of 1.07. Last month, I believe it was 1.16. The month before, it was 1.2. So it's falling steadily. Now, you may look at that and say, well, doesn't that mean that we still have more than one job for every unemployed person? Yes, that's exactly what it means. And you can also see from this chart, the blue line, we have spent a decent amount of time under 1. So even if it falls below 1, not a disaster, because over that period, the economy did pretty well. So it's fine. But here's the issue. Everything that we look at in the labor market right now is low. What I mean by that is hiring is low, quits rates are low, and now job openings are becoming lower. So what does that mean? If layoffs pick up at all because hiring is low and quits are low, those people will have a very hard time trying to find a job, which then feeds through to the data that we actually watch that then will foretell something is amiss in the labor market. We just haven't seen that yet.
Yeah. So Liz, you're focused on your weekly piece on this, right? So you're really kind of getting all geeked up in front of the Friday all important jobs report. I mean, let me just take a step back here. And so that data, makes sense. And we've been seeing it go in this direction. And Guy's been talking about this sort of step function from where did we bottom out, Guy, in the unemployment rate?
3.4, unless Elizabeth knows better than I.
Oh, you're right. 3.4.
Yeah, 3.4. So where were we last? 4.3.
4.3.
Right? And so we've been talking about the SOM rule. We've been talking, Rosie at Rosenberg Research has been talking for, I think, 1.5 years when you see a certain percentage move off of a low, that sort of thing, how equities sort of react. So we've all gotten kind of bored with that data, it was fascinating that the whole investment community was talking about the SOM rule. Guy, you nailed it on Fast Money one day. It was about a month ago or so when Tim tried to catch you on what exactly the SOM rule was, and you kind of nailed it. And you were watching that night, Liz. I remember you saying that. But it seems like, Mrs. Som, or whoever the heck she is, Claudia. She was pulling back from it and just saying, my rule is fugazi, I think she said.
Well, I think it's nerve-wracking to stick your neck out there and say, I'm calling for a recession when all the other data says that everything is fine. So I don't necessarily blame her for saying, look, it's not flawless. It's worked pretty well in the past. It's been pretty flawless in the past, but perhaps it's not flawless. There are some different forces here. One of the other charts that we sent, here's something that I think is important to remember. It's the last chart, if we can pull it up, that Mario sent. It's the unemployment rate and cutting cycles. Yes. Okay. So normally when you see shaded bars like this, they're recessions. In this case, they are cutting cycles, not recessions. And the unemployment rate is that dark blue line. So with the exception of 1996 and 1984, there is not a cutting cycle that you see on this chart that is not paired with a steep rise in the unemployment rate. So you can see, obviously, the unemployment rate is rising where we are right now. We are about to embark on a cutting cycle. I put this up to say all of these declarations about we did it, we got our soft landing, we took care of inflation without hurting the labor market, way premature. We have not even begun the cutting cycle yet. We are not done with this. We can say that once the cutting cycle has happened, and once we add our next blue shaded region and find out that unemployment didn't go way up, but I'm not convinced that that's
so.
Guy,
You've been saying this for a while. I know, Liz, you have too is like they've gone back and forth, at least through the lens of the stock market, going back to a month ago, in early August. It was kind of growth fears and the idea that we are going to have a more material slowdown than a soft landing. And then we were kind of off to the races. The S&P looked like it was going to make a new high, again, through the lens of the stock market. And here we are yesterday. We had, I think that had less to do with growth, although we did see crude getting killed, that sort of thing. There was money just coming out of these really crowded trades. So Guy, when you look at this data, are you saying the same thing? It's like, it went from a few months ago that the Fed could basically drop the mic, if you will, because they've done what they felt like they needed to do. They didn't have to wait until inflation got to 2%. And then we've just had these bouts of like just panic, you know what I mean? Where, they better cut faster than expected or we're going to find ourselves in a hard landing.
All right. So the optimist will say a couple different things here. They'll go back to the 95 analog. And I guess Elizabeth mentioned, I want to say the mid 80s or so, but 95 is where everybody just wants to point. And what they'll say is, outside of those couple times, the Fed was able to sort of, they were able to cut rates because, they were in a position to do so and nothing was breaking. And all the other times, something was breaking along the way, whatever that was. And that's why obviously unemployment went on the meteoric rise that it did. And people will say, you know what, even though we've bounced a little bit here, we're still well below historic norms and they're going to be able to stick this. That's one side of the equation. The other side of the equation is we're just going to wind up seeing what we've seen historically, and that's this escape velocity, a term that Elizabeth used, I've used, some other people as well, in terms of the unemployment rate. And again, getting back to historic norms is fine, except I think it's going to catch the market off guard. It's got nothing to do with where we've been historically. It's sort of how we get there. And I think the market is not, in my opinion, prepared for the inevitability of an unemployment rate a lot higher than we are now.
Nor is the Fed. So we
Nor
talk
is the
about
Fed.
a lot. Even if we look at historical norms, I don't know off the top of my head what the historical normal unemployment rate is during a non-recessionary period, but let's say it's somewhere around 5-ish%. So even if we got to 5% unemployment, the Fed's estimation for long run unemployment is 4.2. And the highest estimate is 4.5. So nobody's above 4.5. So if we get up to 5%, I think that starts to create a Fed that's more aggressively cutting. It's going to look reactionary and the market isn't going to like that.
All right, Liz, I know you've been geeked up for this, and it's the second time since 2022 that the 210 spread.
Hold on, before we do 210s, I mean, this beverage curve, come on. I mean, I can't believe
I skipped over it because
I know you hate this shit because you think it's wonky, but this is actually really cool. I love this stuff.
It's cool. I think it's cool. And
beverage
named after a person, not a beverage, not a drink. Yeah. So beverage is a name. All right. So this is just the relationship between the job openings rate. No, well, maybe.
No, it's beverage.
That would be at 2 hours, I think. Yeah. So this is the job openings rate on the y-axis and the unemployment rate, just the relationship between the two. And we put this in here because what we got today was JOLTS data, job openings data. Yeah. The normal relationship is what you see in that lighter blue dot, right? All those lighter blue dots. Yeah. Now, if you were going to be a statistician, you would know to draw a regression line through that trend. But I think it's pretty illustrative. The trend goes up in unemployment as the y-axis goes down. That yellow dot is where we are today. The other dots are COVID. We're taking those sort of out of the equation because they were awkward and don't really follow the trend. But here we are today. We've got JOLTS coming down more than expected today. If that trend holds, the unemployment rate will rise as we continue down that trend line. So this is one of those data points that if you're a bull or if you're an optimist and looking at the labor market and saying everything's fine, we did it, you got to look at this and say it's not over yet. And I think that's really important to keep in mind.
All right, look, Guy, I thought she added it. She said she added it because I thought she added it because she wanted to bore the crap out of me. But like that,
no, it's this to me is illustrative of what's going on. This is the yellow dot is where we are. Yep. The rest of those dots are sort of the inevitability of where we're going, and it's something that we've talked about that people will say. I've heard them say it. You're missing it. The labor market is different this time. It's not. And Steve Leisman actually sort of addressed that last night on the show. There are a lot of things that are different. Agreed. What's not different, however, I think is going to be the reaction function to an unemployment rate that startles people. Back to you, Dan.
Yeah, no, okay, fine. The only thing I'm saying is that, and we talked about, I think, a little bit yesterday, Guy, the way crude has come in, the way rates are coming in, we're going to get to Dollar Tree and some of these other things, but I think we've kind of explained a little bit away, especially when we look at, there's some pressure on discretionary. There's definitely some pressure on staples at the lower end. But generally the consumer data is kind of hanging in there, and then maybe crude lower and rates lower are the thing that kind of avoids a recession when you think about in the near term. What I'm saying, that maybe helps get to a soft landing, because like these are the things that the Fed was waiting to do. They were waiting for unemployment to get above 4% to moderate wage growth and some of these other input costs. And you know what I mean? So who knows? I mean, the only problem, I've said this again and again, I mean, for a lot of us who are not economists and a lot of market participants, they've been waiting for a recession that was priced in at the end of 2022. Think about that. We're coming up on the 2-year anniversary of the low in 2022. And the S&P was only down, 20-some%? I mean, on 23% or something like that. 23%, the S&P took all of that excess out of the second half of 2020 and 2021 in the markets. And then obviously the economy was humming with all that fiscal and monetary stimulus. It just didn't seem like enough. So again, I'm kind of done trying to poke the other side of that. And that might be the top, but who the heck knows?
Yeah, the last thing I would just say about where we are in the economy now and the declaration of soft landing is that where we are right now, to your point, is good. Everything is in much better balance than it was before. It looks as if we stopped time right now. If we froze everything in place right now, it looks like the Fed can declare victory and say, we did it. We did it without breaking the economy. The problem is what we don't know is whether we're just stopping at balanced on our way to weak. Are we just on a continuum to that weaker spot? And we don't have the answer to that yet. I don't think we're going to have the answer to that until at least the end of this year, perhaps not until even after that.
So Guy, if we could turn back time, would you by the
way, I have one, and again, Amanda, this is not me, I apologize. I do have one share song on my now, I believe, north of 900 song Spotify playlist.
Right.
Which one?
The Whoop Whoop song from, I think, the movie Mermaids.
Oh, wow.
Oof.
Okay.
Yeah. Back to you.
I guess so back to the whole turn back time. I actually forgot what I was going to say at this point, but
you shouldn't be able to be thrown off that quickly.
Right, but no, I got it. So like when you think about it, so consumer spending and then enterprise CapEx, like those two pillars are the thing. If you kind of lose one, you know what I mean, then you probably lose the other. And that's how you find yourself in a recessionary environment, at least an earnings recessionary environment.
Sure. Yeah, I mean, consumer spending obviously drives GDP, but you also have business investment, which is a big component.
That was the whole enterprise spending thing I just said.
Which is a big component of GDP, not as big as the consumer. But I think maybe, in my opinion, it would maybe go the opposite direction. Once businesses don't have the money to spend because the consumer has pulled back, they can engage in CapEx, and then their stock price suffers because they're announcing that they're pulling back in CapEx and so on and so forth.
Well, they do two things. They cut jobs and they pull back in CapEx.
That's right. But I think they pull back in CapEx first to avoid cutting jobs, which is why we talk about the labor market being such a lagging indicator. When do I get to talk about the yield curve?
Guy,
do it right now, the 2s, 10s, because I have it teed up.
Oh, there you go.
I will tell you, since we've been doing this, what Elizabeth has been saying correctly is the inversion is the warning sign. When you should get concerned is the re-steepening and then the normalization. Well, here we are. I don't know, the longest I think in history, I think it goes back to the 78, 80 era. And here we are, Elizabeth, effectively, let's just call it flat for shits and giggles. And this is what you've been, I think this is what you've been concerned about, rightly so.
Yeah. And look, as it comes out of inversion, we're at less than a basis point inverted right now. I don't know if there's a measurement or a name for things less than a basis point. We're at 0.74 basis points inverted. As it comes out, it's not as if as soon as it crosses zero, everything's going to fall apart. That's not how it works. There is a lag to this as well. I tweeted that last week. There is a lag to this as well. But to your point, and to what I have been saying, the inversion is not the problem, is not what gets you. It's the re-steepening, because that's usually the point. The re-steepening usually happens because the short end is coming down. Why is the short end coming down? Because the Fed is cutting rates. Why is the Fed cutting rates? Because the economy is not as strong as it was when they were raising rates. So then you're doing that in the face of a weakening economy. And if there's not enough good data to keep the long end of the curve up, then the whole thing falls. You get a parallel shift down, and you've got rates falling across the entire treasury curve. So what I think is going to continue to happen as we near that first Fed cut is we see what's called a bull steepening. And it's called a bull steepening because it's bullish for bonds, a bull steepening in the curve that will take it out of inversion where the short end falls. It's also bullish for other things. It's bullish for financials, usually in the near term, bullish for real estate in the near term, maybe bullish for some cyclicals as people hope and pray that we're going to avert recession. But that's usually a short-lived period, because then you've got macro data that rolls in and starts to tell us that things are weaker than we expected. So this is definitely something to watch. One of the most infuriating things I hear is when people say that the yield curve is no longer an indicator, doesn't matter anymore, the bond market is manipulated. Drives me crazy, because we don't actually know the answer to that yet. It hasn't come out of inversion, but we are about to find out how this looks on the other side.
I agree with that, Dan, by the way, and that makes me crazy as well. The whole it's different this time and all the things you hear from people that just want to explain it away. And by the way, you mentioned it, a bull steepener. People hear the word bull and they assume that's bullish for everything. As you mentioned, it's bullish for very specific sectors and the bond market. And just to pull up an XLU if you want proof positive, names like Con Edison yesterday made an all-time high, and very quietly, the utilities have just been sort of lower left up. I mean, these, by the way, this is not a technology stock. This is not a biotech stock. These are the utility ETF. I mean, look at what this again, just my opinion, but this shouldn't be trading as dramatically as it does. This should be a lot more boring than it is, and it's anything but, Dan.
Yeah, let's kind of move. This is kind of interesting, and we've been talking about this a little bit, guys. This is the Berkshire Hathaway and Warren Buffett. You know, we've been talking about the Apple situation and Bank of America, how he's been selling. I think he sold half of his Apple position here. I mean, listen, the guy's 94 years old. Looks like he's just cleaning up some stuff. You know what I mean, a little bit. And the whole idea is, you know, let's not stick his successor with a bunch of massive positions, right? So they've built this 300 billion cash pile.
That is a school of thought.
Yeah,
that is. There are people
give
that
us yours.
I don't think that's what's going on at all. I mean, I think the man could live to 110, and he's going to follow the rules that he's been following his whole life. I don't think. I mean, this is just my take, and I'm sure Doug can probably email us with his. But my instincts suggest he's not going to deviate from the norm just because there's a successor out there. It's sort of like the Hyman Roth thing. I think he thinks he's going to live forever, and he's going to abide by the rules that he's abided by his entire investing career. So as much as the bulls will want to say he's paring down positions to give his successor, whoever he or she may be, I think we know who it is at this point, a sort of a flat, you know, a canvas with which to paint. I don't think that's what's going on at all.
Well, if history shows us anything, that any stock could be sold, guys.
Nice. I see what you did.
Right there. All right, let's look at what Doug had a column in the streetpro.com this morning. I think it was really interesting. And he was kind of going back to 2008 when we were in the throes of the financial crisis. And, you know, Warren Buffett at the ripe young age of $80 or 80 years old was bidding for a whole host of, you know, financial companies, getting these preferreds. And Doug kind of links to this Buy American, I Am. And so he's kind of giving a whole host of points here, how I think Doug disagrees a little bit with that, you know, Guy, and some of your takes there. Again, it's what makes a market, but a lot of stuff here. So the reasons why he's selling one way or another, but he also points, Guy, at the end of this, well, you quote this a lot. What is Warren Buffett's favorite valuation metric? When he kind of puts the Wilshire, I think, which is like the all, you know, index sort of thing against GDP, and it's getting kind of rich here.
Not getting kind of rich. I mean, it's at levels it's north of 200%. And by the way, Doug just said, I agree 100%. Look near the bottom of his report. He is bearish, period. He wouldn't pay capital gains taxes as high as $60 billion if he wasn't. So, you know, I think I think he's just following the rules. I don't think, I mean, he obviously cares about succession, but I don't think that's his purview right now. I think his instincts are what they are, and he's doing what he would do if he were 50 years old instead of 94. Anyway, back to you.
So yeah, and again, I actually missed that one point. So I get it. So the capital gains tax, you know, you can keep it forever. And I think Doug put in his note, this was supposedly a forever position. He's made so much money in this thing. He started buying it in 2014 or maybe 13 or something like that. But Liz, when you see this sort of selling out of some of these large names, and Apple is a very different story than Bank of America, but yesterday is also a good example, is like lots of folks headed for the door at the same time in Nvidia. The idea of seeing that stock down nearly 10% in one day after its nearly 7% drop on Friday, I think it was, after they reported their earnings. I mean, that's a heck of a move. So if you're seeing sort of massive selling out of some of the biggest winners of late, or some of the biggest outperformers, and Apple has not been this year, but Bank of America up 22%. And, Berkshire has just been on, maybe Amanda can pull that. It's been a runaway breakout. Berkshire has doubled the performance this year of the S&P 500. Carter did say to us yesterday, on a relative basis, the S&P, it's been an underperformer over the last maybe 10 or 15 years. So thoughts there on just the selling from a guy like Buffett?
Well, first of all, when you have one name and you've got a lot of sellers in the room, also the Nvidia action yesterday made the SMA, I think it took the SMH down 6%, which was the biggest drawdown, I want to say, since COVID, perhaps. It was a big drawdown one day in an ETF that's supposed to be a diversified ETF, obviously not that diversified. So when you see that much selling, there's an analogy that I've heard and I've used about the fire drill goes, or the fire alarm goes off in a crowded auditorium and only one door opens, right? So everybody's trying to get out at the same time. When there's some fear in the market, we saw this on August 5th, the easiest stuff to sell are always going to be your winners. And they're always going to be the big ones because they're the most liquid. They're the most green on your statement. And it's fine to take some gains because the original position you had was much smaller. So it feels good to take those gains when you're scared. So I think this will continue. The volatility that we're seeing in particular names is illustrative, though, of how far we've run up and sort of this forgetfulness that we have about the fact that it can come right back down very quickly as fear enters the market. So I think this is heed the warning. And if you didn't heed the warning on August 5th, heed the warning now. The rest of the market has done decently well at holding up its end of the bargain. So making up for some of the drawdowns that have happened in tech. But in order to benefit from that, you have to actually have positions in the rest of the market.
Yeah, Guy, you remember when Apple had that huge cash pile relative to its market cap? Now it's no longer that important, as you and Doug's pointed that out on many occasions. You have, a $3.2 trillion market cap company, 3.35 actually. And then if you look at that kind of cash, or on a net cash basis, they've accumulated a bit of debt over the last. They have $153 billion in cash, $100 billion in debt. So that cash pile, not particularly interesting anymore. But when rates were much lower, it was a bit of a drag, right? On, so talk to us about $300 billion on the balance sheet of Berkshire.
Well, that's another, I believe, that's another thing to be concerned about. I mean, why you're seeing that type of stockpiling of cash and cash equivalents, unless, he was getting prepared for something. And again, there'll be people that say what he's getting prepared for is his successor setting, again, him up, or him and her, if there's something else that happens, to be able to sort of run things the way they want with a clean palette. I don't think that's what's going on. I think he sees the landscape, and I think he's trying to save for the inevitable rainy day that he sees coming in the form of a lot of different things, not least of which, again, that Buffett indicator that is at north of 200%, is probably at levels we've never seen before, and a couple standard deviations away from where he deems things to be expensive. So that's the way I look at it. And, people will say, well, it's always different. It's not all that different, in my opinion.
The other thing I would offer is, I think we can all agree Warren Buffett is a pretty responsible investor. You have to believe that he knows an announcement like that is going to move the market. He's going to move the market in one of the most important stocks in the United States. So I'm sure he doesn't take it lightly. And I'm sure he doesn't come out with an announcement to sell this huge stake in something like Apple without thinking through what the risk factors are and how he might affect other investors. So if it was just for the purpose of trying to set something up for the next level or the next phase of Berkshire Hathaway, I feel like he would have done it in smaller increments.
Yeah, and just think about this. So he sold, half his stake, and if you think about it, so he's left long 400 billion shares. Okay, like just think about that. There's a lot of zeros, a lot of commas. Okay, so 400 million shares. Sorry,
400 million. Yeah, I was going to say.
but it's still, you know, a massive hundreds of $billion position. So just take that 400 million and multiply it by 220. That was clearly weighing on the stock. If Amanda can pull up a 1 year or 2 year of Apple, you know, there was massive outperformance, and we were explaining it the way massive outperformance from, you know, the Meta and the Nvidia and all these other names. But look at that long consolidation. I mean, they were selling this thing for months. It was keeping a lid on the stock, and when he got done, you saw the thing pop, and it popped on some fundamental news. So again, that's interesting enough to me. All right, guys, should we move forward here a little bit? So Amanda wrote, chips dipped, now what? A couple headlines here. A lot of folks were saying that maybe they're running ahead in the Nvidia of this DOJ story, the subpoena and the escalating antitrust probe. We talked about it on Fast Money last night because I think it hit right after the close. I think you and I are both think it's a bit of a silly thing if we think about regulation for all of these companies. They're talking about breaking up Google. That's never going to happen. They're talking about Amazon. So thoughts here, whether you think this is a particularly impactful story. Guy, if the stock was unchanged yesterday, would you have seen like a big leg lower on this?
Look, I don't, again, I mean, it's not positive news, obviously, but I think there are a lot of reasons to be concerned about the stock of Nvidia. I don't necessarily think this is one of them. And again, you know, you brought this up and you were correct to bring it up. You actually sort of channeled your inner Larry Kudlow for a second. But if we're at a point in our history where we're starting to demonize success and try to sort of vilify success, I mean, that's problematic. I mean, it's not Nvidia's fault that, you know, they have such a wide lead. I don't think it's, you know, I don't think it's antitrust. I don't think it's anti-competitive. I just think they're that much better than everybody else. So, you know, there's a fine line between the two, and I think we're sort of skating on it. With all that said, you know, there are reasons to be concerned about the stock outside of this headline.
Yeah, the one thing I'll just say, so it's not just after reading that, you know, we saw the headlines last night, but after reading the story, so it's not just, you know, the grip that they have on these high-end GPUs. It's also the ecosystem, the software that basically locks you into it. So it gives you, and this is no different than when the government came after Microsoft and they had, you know, Explorer embedded into, you know, Office and everything like that. So again, it's worthwhile keeping, you know, tabs on this sort of stuff, largely because let's just say AMD and Intel are trying to get there from a competitive standpoint, but they've already created a lock on it, you know, on the whole business because of this software ecosystem. We know AMD and Intel are going to be lagging behind that. And Liz, to your point, you know, the SMH about construction, nearly 40% of it is Nvidia, which has 85% market share of high-end GPUs, and then Taiwan Semi that probably has about 85% market share of, you know, making these GPUs. So when you think about that, you are all in on one theme, and Broadcom's the third largest, about 8.5 or so. They report later on the week, Guy. I think you and I agree that's going to be a really important one. And before we get your take on semis versus software, Liz, really quickly, AMD, there's a headline today, and AMD is up 3-4%. AMD hires former Nvidia VP to lead their global AI strategy. And then the other piece of data in the space, and Guy, you talked about this a little bit last night, is that Intel's money woes, this is interesting, throws the Biden team's chip strategy into turmoil, because I think they were set to get, what, 10 billion or something like that to build fabs. We know these fabs take years to put in place. So again, if Intel is getting crushed, if they want to pull up the Intel chart for a second, if it's getting crushed, they might have to spin out their fab business, and therefore they're not going to get all this money from the chip.
Well, you got to bet on the right horse when you go to Saratoga. And, you know, I think, again, I think the administration was doing the absolute right thing in terms of this initiative. But, you know, with that said, if you bet on the wrong horse, regardless of your, you know, your intention or how well thought out it was, if the horse loses, you lose. And I think to a certain extent, that's what we're seeing here with Intel. I mean, you know, they talked about sort of shuttering their unprofitable, or I don't know what the term exactly was. I mean, there's nothing right now about Intel that's exciting if you really look at it. And quickly, and I don't want to get bogged down here, but think about what the market's done. Think about what semis have done. Think about what people have been saying about the entire sector. You know, semiconductors for the last 2 years have been everything everybody's been talking about. Yet Intel not only can't get out of its own way as a stock, they're laying people off in an environment where they theoretically should be hiring people. So no mas, no bueno, as they say.
So that's a good example. A board member last week resigned kind of suddenly, and he disagreed with their strategy as it relates to AI, and he was kind of overseeing that, and then also thinks that they should have cut a lot more people than that 10% cut or so. So, Liz, a lot of headlines there. The top dog selling off the way it has, it's giving you all these sorts of excuses to sell everything else in the ecosystem.
Yeah, it is. And you mentioned semis versus software. I've talked about this a lot. When you look at just the relationship between the two, it's usually a cyclical indicator. And if you look at it over a trailing 1 month period, semis have now fallen below software as far as performance goes. It's only been a couple days after the big drop off in Nvidia and the SMH, but it's happening. So if that trend continues, that is a non-cyclical indicator, meaning that software typically outperforms. Now, in the case of we have a serious macro issue or something happens in the economy where things are really cooling, I don't want either of these industry groups, frankly, but you can look at other things like the gold versus copper ratio for that. You can look at consumer discretionary versus staples. But this is something just inside of tech that I do track, and it doesn't look good for a lot of upside to come.
Yeah, Guy, let's look at it again. She's just talking about staples versus discretionary. I mean, I think we can all agree that the dollar stores are about as staple-ish for that sort of consumer. Talk to us a little bit what's been going on here. You've been highlighting the relative weakness, and we know, and you and I talked about it a little bit yesterday, Walmart and Costco, they seem to benefit from the high end trading down or the low end trying to find, a broader scope of things at good value. And these stocks are just falling out of bed. What is it telling you about this?
Well, they're crashing, and I rarely use the term, but I mean, that's Dollar Tree, put up a Dollar Gen chart over the last few years, and if that's not a crash, I don't know what is. And what it means to me, reading through these transcripts and sort of listening to some of the dialogue around the companies, historically, when things slow down, people trade down to the dollar stores. What we're seeing now are people trading down from the dollar stores. I mean, that's nuanced, but not really. I mean, I think it's a really important distinction. And on the other side of the equation, Walmart wins because people are trading down from whatever to Walmart. So they're seeing a customer that historically they never saw in terms of income levels. So this whole trade down effect is not suggestive, in my opinion, of a robust economy at all. And I think this is really something that the market, for whatever reason, doesn't want to talk about it. It's not politics. It's just factually true. And I think that's one of the, when you think about the stock market effectively at all-time highs, and we've talked about this, one would think that the approval rating for this administration in terms of the economy would be at record highs as well. And it's actually quite the opposite. So something's going on here, Dan.
Yeah. So, Liz, when you see this sort of price action and Guy used the C word, I wasn't going to use it. What does it tell you about the consumer? And again, so if you have a higher end consumer trading down to Walmart, and then Guy, who knows what these guys are trading down to. And it's sad. I mean, to your point is that, the wealth effect has been a great thing for owners of assets. And we've been talking about that when interest rates were low. And to Guy's point, when interest rates went higher, the stock market went higher. You know what I mean? Now that rates are coming down a little bit, I mean, the stock market's still very near its highs, but the loosening of the housing market might be something pretty good for housing prices, because they were kind of stuck for a while with rates as high as they were.
Frozen. I mean, the housing market was completely frozen. So a little bit of a counterpoint on this, or a suggestion of something else that might be going on, is that stores like Dollar Tree, Dollar General, different pricing structures than stores like Walmart and Target. And some of the results that we heard from Walmart and Target were things like volume picked up. Consumers are still spending money, but volume picked up in places where we rolled prices back, where we introduced price cuts. So here's part of what I think is also going on. The consumer, all of America is not living under a rock. They all know that the rate of inflation has fallen. So then they expect that to be reflected in prices. And if they're going to stores and they're seeing price rollbacks, price reductions, they're happy with that. Maybe it's not down to where it was before, but it's just intuitively, okay, inflation has come down. I expect prices to come down too. So they're happier. They start spending money at the stores that are reducing prices. So I think there's also a possibility that some of the customers that were shopping in those dollar stores, although yes, there absolutely is a trading down effect, which is terribly sad. Some of the customers that were shopping in the dollar stores, I think, also have switched over to something like Walmart, which is why we saw such rock star results from Walmart.
Yeah, I think that's a really great and nuanced point about this, and I think we'll probably see more of that as we get into Q3 earnings in, I don't know, 2 months or something like that. All right. If it's Wednesday, you know what it is. It's Butters. That would be John Butters. He is the senior earnings insight analyst at FactSet. You can get his report in your inbox every week, Friday morning, insight.factset.com/subscribe. Liz, notice that there's no dashes in that. You know what I mean? I'm just saying. Okay, so insight.factset.com
Those guys say,
slash
don't at me.
Yeah, subscribe.
Or do at me.
So we get to preview it on Wednesday.
Uh-huh.
Okay. So I think this one's really interesting, guys. So we get his work, like we said, every week, and we've been tracking this sort of stuff. All right, let's hit this right here. The Q3 bottoms up EPS estimate for the S&P 500 decreased by 2.8% during the first 2 months of the quarter. Now, John's highlighted this. We often see that, except we haven't seen it a lot in the last year or so. Okay. This is larger than the 5-year average, down 2.7%, the 10-year average down 2.6%, and the 15-year average down 2.3%, but smaller than the 20-year. All right, God. All right,
Too long.
We get it,
long
Butters. All right. I mean, I love you, buddy, but I mean, just give me the 5 and 10. 10 of the 11 sectors recorded a decrease in EPS estimates led by energy. That makes sense, down 11.7%. No sector witnessed an increase in EPS estimates during the period. So, guys, that's the thing I kind of want to focus on, because I feel like John's work over the last few quarters has been highlighting what the 5, 10, 15, and 20-year averages have been, but we haven't been getting close to that. So here we are.
That's what you should be focused on. I think you're correct to point that out. And again, 20-year average, a lot's been different over this last 10-year period of time for a myriad of different reasons. So I get why one would be encouraged that 2.8% is still very reasonable when compared to the average we've seen for the last 20 years. Got it. Okay. But with that said, over the last 5 or 10 years, you see the trend is obviously going the wrong way. And 10 of 11 sectors in a decrease. I mean, forget about energy. For whatever reason, every time we do something with John, energy seems to be the outlier. But no sector witnessed an increase in EPS during this period. That's something one has to take into consideration, because what I think it means to me, Dan, is a lot of the move to the upside we've seen in the market is in the form of multiple expansion. It has really nothing to do with earnings growth or revenue growth.
Yeah. So, Liz, when you look at this data, we already talked about in 2022, when the market was being priced for a recession, all we got was an earnings recession. So when you see data like this, what does it make you think, especially with your kind of lukewarm view of the economy right now?
Well, lukewarm at best, I would
Yeah.
say. I think it raises the question of, was that earnings recession just a little bit of a head fake? It was really only 2 quarters long. It wasn't that deep. Usually the sequence of events is that the market goes down first, then earnings, then the economy. We just never got the economic piece of that, which is why there was so much confusion and indecision about whether or not we actually did secure a soft landing. So now I think we're going to see what happens this time around. The market has not done its down thing yet. So that would be the first step. And then you got to have earnings happen. Now, this stuff takes longer. I think we've all learned in this cycle, and it's something that Jeffrey Gundlach says all the time. It just takes longer than you expect every single time. So it's possible that we go through a redo of that, where we find out, okay, the market needs to shake out some excess. Then we find out that earnings need to give a little back. The economy cools. I don't know how it ends. I don't know how the movie ends. I wish I did. Obviously, I don't. I've been trying to call the end of the movie for a while and been wrong. But this is not necessarily something that suggests we are in an overheating economy or in early cycle behavior.
We have a lot of questions. Unfortunately, time is of the essence here, as I have to get my diminutive ass into a car. And when I say that, I suffer from I want to say it's not a fatal disease, but it is a hereditary disease of no ass at all. So I will be in a car in a few minutes to head into New York City for CNBC's Fast Money. But I promise you that the questions that you submitted today, in addition to any questions tomorrow, will be addressed. Dan, Nathan, back to you, because I don't know if it's 16-week or 17-week, but Market Matrix, man.
Oh, killing it. Hey, before we get to that, you guys are watching this on YouTube. Go like it, leave a comment. Like, we'd love to hear. Amanda reads everything in there and relays a bunch of that stuff.
Smash the like button.
Smash the like button on the YouTube. We appreciate it. Market Matrix. This is an AI generated podcast. Our team we curate 10 of the most important, at least to us, business and market stories. We put them in Perplexity. We give it a prompt to summarize it. Then we put it in 11 Labs. That's a voice bot. We call it Brunson, and you get this amazing little podcast in under 10 minutes shortly after the close. And the best part about it is you don't even have to listen to Guy or me, because Brunson, he's coming alive here. So it's a great pod. Go find it in your favorite podcast store. Listen, like it, share it, review it. That's how people find it. So we appreciate it. Guy, you better get that No Ass at All looked at, because some of us are a bit worried. I'm just saying, I mean, like, we don't want to let something like that get out of control, because that would be,
well, I think that Genie is, and that's a song by, I think, Christina Aguilera, Genie in the Bottle. Well, that Genie Elizabeth is out of the bottle, as they say.
Okay.
But maybe there's a food group that I could start to eat more of that would help.
Something highly caloric.
No,
perhaps.
listen, let's be
Peanut
very
butter?
clear,
I don't
because
know.
I think this has gotten off the rails.
Simple
Karen
carbohydrates.
Feinerman, and I hope I'm not giving it up here, she really enjoys that guy. She kind of suggests that all the time. It just means that it's not like Kardashian level ass. Like that's what we're talking
No,
about.
it's the exact opposite,
Anyway,
actually.
Get it into the city.
Yeah. Okay.
Well, regardless of size, it is headed into the city.
You got to bring it with you.
Adios, people.
All right.
See you
Thanks,
tomorrow.
everyone. All right. See you.